Welcome to this trading tutorial on a Forex strategy that works so well that I trade this every time it sets up to this day. So I've been trading this for years, and this darn thing just continues to work and work and work. It is so reliable, and I'd like to give you a little introduction to it on this YouTube video, and then make the entire trade setup and rules and all that available to you absolutely free if you're interested. So here is the Forex trade strategy that works. By the way, this also works on stocks, E-minis, futures, gold, crude, ETFs, pretty much anything you can chart. And I've been trading this for years. So here it is. And let's introduce a couple of general concepts to set up the trade and why it works, the logic behind it. So it's generally accepted, and I will be the first to acknowledge that there are many variations within this, but generally acknowledged in the trading community that there are two types of dynamics in the market, and that is trending and then reversion to the mean type of trades. So certainly within the trend trading, we can include such things as low volatility breakouts that are starting a new trend. Trend reversals are a type of trend trade, even though they're a reversal trade. So a lot of different subcategories under trend trading. And a lot of people know about that. So that is something that is very well known. But I find that reversion to the mean trades are not quite as well spread throughout the trading community, and that's what this one is. This is a reversion to the mean type trade, and I like these kind of trades. They're not typically as big of a reward to risk ratio, but the win-loss ratio on that can be very, very high. So this can be a great way of making some money while you're waiting for trends to set up. And some people say that the markets only trend 20% of the time, so kind of nice to have another type of trade to be able to use. So anyway, this is the 50 MA, this green line here, and that's the 50 simple moving average. And it's very important that with this type of trading, you use the simple moving average and not an exponential moving average or any type of moving average that would be faster. So that's one thing that kind of blows people's minds, especially beginners. They think, well, wait a minute, I don't want the slower moving average, I want the faster one, because the faster moving average will follow trend and price action more closely. And ironically, that's exactly the reason we don't want it. We want something, well, think of it this way. If you get a moving average that follows close with price, it becomes useless. The closer it follows price, the more useless it is. The moving average that would follow price most closely would be a one-period moving average, basically just connecting every bar. So you don't need that. You could see the price bars. So whenever you use any kind of indicator, whether it's a moving average or anything else, the only reason to put it on your chart is to show you visually something that isn't obvious just looking at the price bars. So when it comes to reversion to the mean, you actually want to use a slower and even lagging indicator. So counterintuitive to a lot of people, most people think, nope, I want the fast indicator. And in my approach to trading, I actually always use a combination of a lagging and leading indicator. And that's part of my strategy. I use the two in combination together. And that really is optimal. But we won't go into all that right now. Let's just basically focus on the concepts. So the 50 MA we'll use as our intermediate trend indication. And this is the type of thing we normally see in trends. So prices above the 50 MA. A little retrace here. Goes up, higher highs, higher lows, etc. Okay, so that's great. That's the kind of thing we expect in a trend. And if we can continue going up, then what do we see? Again, we see the typical kind of thing that the market then goes into more of a sideways pattern. And we see that by the 50 simple moving average kind of flattening out because it's a moving average. It's never going to go exactly perfect straight line that goes horizontal. It'll wiggle a little bit, but basically going sideways, price action goes sideways. This is one type of cycle in the market, by the way. Most people think of cycles of being low, high, low, high, low, and that is one type of cycle. That's the oscillation type of cycle. But there are actually many types of cycles, and one of them is the trending and non-trending cycles. The markets go through times where they trend and then they go through times where they are not trending. So that's another type of cycle. All right, so that's fine. Then we continue to go on. Let me show you a reversion to the mean type of example. So now we get back into a trending market. 50 MA going up, price going up, higher highs, higher lows, all that. Great, that's what we expect. Cool, works out great. Come back down. Now, here is what we're looking at. Okay, this is a reversion to the mean type of pattern. So now what we have is, wait a minute, the 50 MA, and here's the basic structure. It's a price structure type of trade, and we had a few extra details to it, but here's the general structure of it. So now we get something different. Instead of price continuing to go up as the 50-period simple moving average is going up, we actually have price go down below the 50-period simple moving average for the first time. And it goes down pretty hard. So it's below the 50-period simple moving average, but guess what? The 50-period simple moving average does not move down. It continues moving up. And that's the structure. That is the key price structure. Now, if you used a 50-period exponential moving average, or you used a faster moving average, you wouldn't get this structure because the moving average would start to move down, and therefore you would not be able to trade reversion to the mean types of trades very well. So this is the real structure here we're looking for. Price bars below, again, an upward angling 50-period simple moving average. And we are looking for it to then get back to the 50-period moving average. That's our first target, by the way. And then sometimes, of course, it will go even further and the uptrend will continue. So this is basically what's happening here is a high volatility move to the downside in a short period of time. So we could create a rectangle with that. That's what I normally do. But this is the structure. As you see, this is not the norm. So these are trades that they do set up. The nice thing is you can actually scan for these trades pretty easily. So if you have any kind of scanner, it's real easy to basically just set up a scan that says, price bars, but you want the open, the high open, low close, all that stuff, the entire bars to be well below the 50-period simple moving average. And then you just put into the scan prices below the 50 MA, and the 50 MA is angling up. In other words, the close of today is greater than the close of 1 day ago, 2 days ago, 3 days ago, something like that, to have the angle of the 50-period simple moving average angling up. So that simple little scan, program that into whatever scanner you use, can help you find these trades. Because, yeah, they don't set up a lot or all the time, but frankly, most of the best trades in the world are the ones that don't set up that often. They're a bit of an anomaly, and they seem counterintuitive. And that's, ironically, what makes them actually work, because a lot of people aren't going to trade that. They don't get it. They don't understand the philosophy, the mathematics behind it, and the trades that most people take are the ones that don't work. The professionals understand, an anomaly like this is something that gives you an opportunity that most retailers are not going to take. So that's the basic structure. Now, there's a few other rules around this, which don't have time for right now because I always keep my YouTube videos under 10 minutes. But I'll give you all the rules, everything, absolutely free. We've got, it takes about 26 minutes. I've got a video that I'll be happy to share with you absolutely free and shows you in about 26 short minutes this, which I call the rubber band trade. It's called the rubber band trade because basically it's stretching away from the 50 MA, and then it snaps back to the 50 MA and sometimes beyond. So it's that snapback that makes me call it the rubber band trade. So to get that rubber band trade strategy absolutely free, just simply click on the little eye with the circle around it in the top right hand corner of this video. And if you're not watching it on YouTube, there's a link below the video or an opt-in form on the side. And once you do that, I'll personally email the video to you with the entire rubber band trade strategy with all the rules for timing, all the details that make it really work well for you.